Right. When we are talking in the process of the business trust, when we are talking about the business trust, this process is very much clearly known to us. A trust registered as in the infrastructure investment trust or real estate investment trust. In Indian financial system, only two types of investment trusts are accepted. One is a investment trust in the real estate investment, and second is that infrastructure investment. Real estate trust means providing all the real estate facilities. Second one, infrastructure is building of rails, road, constructions, etc., etc. Then a trust registered as an infrastructure investment trust or a real estate investment trust, the units which are required to be listed in the stock exchange in accordance with the regulations made by the Securities Exchange Board of India's Act 1992, under para 15 and 1992, and notified by the central government itself. So all these units are to be clearly mentioned in that. Then, so what are the types of investment trust? This is the most important aspect in this. When we are talking about the when we are talking about this one, so real estate investment trust. First one is a real estate investment trust. Real estate investment trust. When we are talking about real estate investment trust, real estate investment trust. These, in the case of real estate, a new form of investment into the real estate sector is basically function exactly like a mutual fund. So there's no difference in this. Actually, all the phenomena that whatever we have studied in the mutual funds, that will apply here. So as they, in the case of the real estate investment trust, the money is pulled up from the various people, either it is a holding company or maybe the proprietor or so on and so on. So when it is money is collected from the small investors or sometimes large investors also, and they are invested in the real estate assets like physical assets, that is commercial property, holding property, and development of the property in the real estate. So real estate investment trust, broadly speaking, they will collect the money from the general public. Along with that, they will invest in the various real estate investment aspects, that is a commercial property or so. They will pool up the resources. Then whatever the return that is coming out, that will be passed on to the investor. This is very, very useful investment opportunity for those who are really interested to invest in the real estate sector, but they are not able to invest because of lack of knowledge or because of huge amount of money is not available and various other reasons. Those who are interested to invest in real estate business, but they are not able to invest directly from their behalf. Then real estate investment trust will act as a mediator between the person who is ready to invest and also the person who is ready to invest and also the real estate. So in return of the money, the invested by the unit holder will be in the form of, either it may be in the form of dividend, or it may be form of interest income, or it may be sometimes a rental income. Nowadays, we are seeing this rental income concept in the various newspapers. You invest in a real estate business, and then they will invest they will invest in construction of a commercial complex also, and to the proportionate value of your investment, they will provide a rental income. So instead of directly purchasing our commercial flat, you can invest in a real estate investment trust. So accordingly, three types of real estate investment opportunities they are available. One is equity real estate investment, which purchase the own and manage income generating property. Equity means own. Normally, equity shares, that is ownership shares actually. So in the case of equity real estate investment, we purchase the shares own the business and manage the income generating properties. Second one is mortgage real estate investment trusts, which lend money to real estate owners either directly or indirectly. Then hybrid type of real estate investment aspect, which are combination of both equity and mortgage. Either you buy directly the units of real estate investment trust or mortgage investment and so on. This real estate investment trust is very, very successful because it helps to overcome the problems of the real estate investors, like huge amount of money is needed, but they are not able to procure. If 10 people invest 1 lakh rupees each, it becomes 10 lakhs. Each person invest 1 lakh rupees, it will become 10 lakhs, like that. So then these real estate investment trusts, they are very much helpful for the process of getting huge amount into the real estate business aspect. This is the broader outcome of the real estate investment trust. Then we talk about infrastructure investment trust. This infrastructure investment trust is a separate type of investment trust which mobilizes the funds to project and like roads, highways, toll roads, power plants, telecommunication infrastructure, and so on and so forth. So infrastructure investments are catered to the designated to mobilize the funds for the various projects like infrastructure projects. Infrastructure projects is what? Building of roads, building of highways, power plants, telecommunication infrastructure, etc. These normally are considered as the infrastructure investments. Then these infrastructure investment trusts, they will collect the money from the people who are invested to invest in these type of sectors, and they will develop the assets, and they will relating to infrastructure projects. And the primary objective of investment infrastructure is to promote the investment in the infrastructure sector. Directly, the people may not having the access to that, or they may not be able to have, they may not be having the knowledge about how to invest in the, how to have an investment in the, how to put their investment in the infrastructure sector. Through this particular infrastructure sector, with trusts, they can invest. So infrastructure companies are attached to all types of the risks and institutions. Then in such a case, heavy risk bearing capacities will not be there, and high volume of investments are required. In such a case, this infrastructure investment trust will help them to collect the necessary requirements of funds and so on. So these are the various aspects that are covered under the investment trust. Then management of investment trusts, para number 10.6 para. 10.6 para. In this, how to manage the investment trusts in this class. So first one, active management trusts, and second is passively managed trusts. Some actively managed trusts, they are directly fund managers are appointed. Fund managers are appointed, and these fund managers, they will provide the active strategies towards the firm, and they will collect the more and more amount of money from the general public, and they will invest, and finally they will generate the positive returns, and these positive returns are shared among the various investors. Then these are or sometimes passive management trusts are also there. These are passively managed, replicates the index of holding the generated performance in that, just the same as index. So they will depend on mostly indexation. So indexation means like we are stock exchange index. The indexes will be there. If the money invested in this trust, if the index goes up, they will rise, otherwise no. So top-down approach, bottom-up approach. In the case of top-down approach, macroeconomic factors adopt the approach by the purchase of by the phase-wise economic analysis factor, and a bottom-up approach will be conduct of thorough financial analysis and knowledge of specific investment and so on. So these are the various aspects that are to be how to manage this one. So in the investment trusts units, the very important aspect is that what are the various types of investment trusts? What are the various types of investment trusts? And briefly note about a real estate investment trust and infrastructure investment trust. and how these investment trusts are different from the mutual fund investments, and what are the various management strategies towards the investment trust. These are three important aspects that every student has to understand in that. Then coming to the next lesson, that is that is mutual funds. When we are talking about mutual funds, that is unit number 11. Unit 11, mutual funds. This is very much known to us in general. Mutual fund. A mutual fund is a trust or a pool of the resources. So which the savings are collected from the general public, and these resources are provided to the various required people, and their mobilization of the savings is done on that. So the value of these investments are made in the form of value of units are represented in the form of NAV, net asset value. So when we are talking about NAV, net asset value, so what is the value of the net asset? That means mutual fund units value. In the case of share market, share value is represented by the market price. In the same way, unit trust investment value is recognized by the depends on the net asset value and then unit value. So net asset value is the market price of each unit of a particular scheme in relation to its net assets. What is actually net asset value? That is to be understood first. Net asset value is based on the balance sheet approach of the firm. In the case of balance sheet, as all we know, the total assets are represented on the asset side of the balance sheet, and various current liabilities and outstanding expenses are represented on the lower bottom side of the liability side. And if the current assets, current liabilities and expenses are subtracted from the total assets and divided by the number of units which are issued by the unit trust by the trust, that is by the mutual fund units, then it will come as a NAV. NAV is equal to total assets minus current liabilities and outstanding expenses whole by total number of units. That is the formula to calculate NAV. So every person who wants to have a return, huge amount of return, every person who wants to invest in the capital market operations, first they will look about the shares, because shares are more popular. Almost all share market, stock market, one day or other, every person will talk about. Then second, immediately those who are not able to take up that much of risk if in the share market, they will go by purchasing of the mutual fund units. Why we are talking about mutual fund units are, this is less risky when compared to the equity share investment. In the case of equity share investment, the investor directly engaged in the participation of the investment activity. But whereas in the case of the mutual fund investment, the investment activity is carried out by the fund manager of the investment activity is carried out by the fund manager of the mutual fund. So mutual fund organization. So let us broadly discuss about what is the differences between, this is the most popular question, 11.3 paragraph number. When we are talking about 11.3 para. So when we are talking about the differences between the mutual fund equity shares, in the case of mutual funds, diversification of funds is possible in the case of mutual fund, as money is pooled from the different investors and invested in the shares, bonds, and several companies. The mutual funds, they will collect the money from the several investors, and basing on the expert opinions of the mutual fund managers, they will invest in various bonds, various funds, various shares, and so on. So that is the process how diversification will go on in the case of mutual fund investment. Whereas in case of equity share investment, diversification is limited towards the shares of various companies. That's all. So second important point, in case of mutual funds, they are managed by professionals. Mutual fund managers are there. But in case of equity share investment, research is a responsibility to research about the shares is exclusively the sole responsibility of the investor alone. He may depend on the technical, he may depend on the, just 1 second, power off problem. He may depend on the process of his own knowledge, or he may be going towards the expert opinion. But it is, if he is able to closely monitor, sometimes equity share will give more return. But if you are not able to closely monitor, or if your expert knowledge in the stock market operations is not available, then in such a case, it is better to go by the mutual funds, which are less risky. Third point is the mutual funds are sold in the form of units, and unit holders are connected with the growth of the company. Then, whereas in case of equity shares, investors become the shareholders of the company, and based on the performance of the company, investment may grow or may not grow. And sometimes dividends may be declared by a company, sometimes dividends will not be declared by the company, and so on. Capital risk is very much minimum in case of the unit trust organization. The capital risk will be minimum. But whereas in case of the equity shares, risk of capital is very high. Sometimes there is a possibility to lose the investment if the stock market prices comes down. So investment in mutual funds is easy when compared to the equity share investment. Investment in equity shares will consume a lot of time and so on. For example, the investment in the equity shares requires a demat account. What is a demat account? Dematerialization account. That is separate account is need to be operated by every investor. But in case of mutual fund units, this is not required. To invest in the mutual funds, as I told you, the involve charges like exit load and total expenses ratio. Exit load to total expenses ratio. So, whereas in case of the equity share buying and selling, brokerage charges need to be borne by the investors in the equity shares. So, brokerage charges is to be paid. This is actually unit trust purchase is an indirect way of investment in the process of that. Unit trust is the investors in the stock. Whereas the equity share participation is a direct way of involving in the share market operation. These are the various differences which we have to understand between the share prices and equity shares and mutual funds. So, what are the basic important advantages of investment in the mutual fund? That is the most important element. What we have to understand this. So, why we have to prefer the mutual fund investment? Better to compare about the equity share when compared to the equity share, when compared to the bonds and so on. So, what is the advantage of investing in the mutual fund sector? So, diversification benefit always will be there. Every mutual fund investment is a diversified portfolio. As I told you just now, the investment in the mutual fund, if we put the 1,000 rupees in a mutual fund organization, the 1,000 rupees is diversified into various company shares or bonds or something, depending on the ratio. Then, secondly, the low transaction cost. For investment in the mutual fund, the transaction cost is very much limited when compared to the other types of investment operations. Availability of various schemes. Unit Trust of India, say for example, earlier it is various schemes are there in the case of mutual fund sector. Mutual funds generally offer a number of schemes to suit the requirements of investors. Thus, investors can choose between regular income schemes, growth schemes, and IT savings, income tax savings schemes, and so on and so forth. Then professional management. Normally, these mutual fund organizations are well managed by the professional managers. So all these professional managers, they will use their technical skills and then try to increase the value, increase the net worth value, and finally the NAV, net asset value of the units will definitely grow. So these are the various impacts. And next point is that liquidity. In the case of liquidity, unit trusts, they are basically very much liquid. So mutual fund units can be traded across the share market, sometimes quoted, unquoted, and so on. So liquidity will be there in the case of both. And tax benefits will also be there in the case of mutual fund units. They are well regulated. Actually, mutual fund units, these are not chit fund units. Mutual fund units are well regulated by the Securities Exchange Board of India and they are very much transparency is maintained by them and flexibility is there. These are the various types of factors that everyone has to understand this. Then coming to these are the various advantages. This is a very normal question. What is meant by a mutual fund and how it differs from the investment in equity shares, or what are the advantages of investment in the mutual funds, and standard questions will be there in the syllabus aspect actually, as I told you. Then lastly, let us take up one more topic, and with that we will close this unit, that is 11 also. Types of mutual fund companies. So broadly, what are the various types of mutual fund units? What are the various types of mutual fund units? Para 11.5 you have to refer. Types of mutual funds. So broadly, these mutual fund schemes are classified into three types. Dave? When we are talking about the various types of mutual funds, on the basis of category, open-ended fund and a closed-ended fund. What is an open-ended fund? By structure of mutual funds, we are classifying the mutual funds into two parts. One is open-ended fund, second is a closed-ended fund. Open-ended fund means the fund is open. At any time, the investor can buy. At any time, the investor can exit out of the mutual fund. So free entry, free exit. But okay, charges may be there on that. So, but entry is free and exit is also free. The key feature is that open-ended scheme is very much liquidity. At any point of time, the investor can invest. At any point of time, the investor can exit out of that. Whereas closed-ended fund, in case of closed-ended fund, the issue open date is mentioned, and issue open date is mentioned, and when the issue is going to be closed is also mentioned in this. So if the issue is closed, the units cannot be purchased. After a certain period of time, then only the fund units can be traded. So if there is a time period to buy the units, it is called as closed-ended. If it is continuous basis, then it is called as open-ended. Then interval schemes also. Interval funds combine the features of open-ended fund and a closed. Interval means for every certain period, they will become open-ended. Again, after a certain period, they will close. So they will give a certain period of time, and during that time only the operations can be carried out. So open-ended, closed-ended. Next is by investment objective. The investment objective, the units, the mutual fund schemes are classified as. So one is that growth scheme. So aim is to growth scheme. In the growth scheme, the main aim is to growth of the funds is provided by the capital appreciation over a medium term to long term. So unit value will increase. When the person sell off that particular units, their value will increase. Second one is income scheme. In case of income scheme, the income funds are ideal for the capital stability and regular income. If a person requires a regular income, then in such a case, the investor can invest in this type of income scheme. Balanced schemes are also available, and these balanced funds or balanced schemes is provide both growth as well as income. My investment should grow as well as I need some income. So this idea of investors is looking for a combination of income, then moderate growth will be there in that. Then lastly, money market schemes also there. The idea of corporate and individual investors as a means to get surplus funds for the shorter period. So money market operation schemes are provided liquidity, preservation of capital, moderate income, all these aspects. So lastly, special schemes are also there in this case of it. Special schemes offered by the mutual fund organizations are tax saving schemes. So equity-linked savings schemes, pension schemes, etc., which are allowed as acceptable investment in by the Income Tax Act. So if you invest the money in that, whatever the rate are, sometimes it is exempt from that. So indexed schemes are also there. Indexed schemes, indexed funds attempt to replicate the performance of particular index, stock market index, such as BSE index, NSE Sensex, and so on and so forth. Sectoral funds are the funds which are related to specific sector, like infrastructure units, so like telecom industry units. So if any mutual fund organizations, they are restricted to that, then they are called as sectoral funds. And gilt funds, which are invested in the government securities, floating rate funds, and cash and treasury management funds, high yield debt funds, fixed monetary income funds, like that. Various monthly income uh, plans are also is available in the case of the mutual fund units. So these are various types of, still so many types are there, but only few of them is enough to understand, and you can recognize, you can memorize that one. So with that, we have studied about the various types of mutual fund units also. Okay. So to conclude upon, in this particular class, we have completed about 2 units of the block 3, and that is one, the block number 10, which is out of the block 4, that is investment trusts. How the investment trusts are there? 2 types of investment trusts, that is real estate investment trust, infrastructure investment trust, and what are their advantages and so on we have covered. Then how these investment trusts differ from the unit trusts, then how this is one, then how this, then coming to the next lesson, that is 11, in that we have discussed about the mutual funds. In the case of mutual funds, how these mutual funds operate and what are the types of mutual funds, how the mutual funds differ from the equity share participation, what are the various types of mutual funds, and all these aspects are discussed with that. Thank you. Thank you.